Welcome to TradeSpoon. My name is Vlad Karpel and I'm the founder and CEO of TradeSpoon. And today I want to talk about a very important topic. How do you calculate the risk when you trade? So let's take a look. Well, how do you determine risk? At TradeSpoon we provide you with different tools to figure out what is the risk you're undertaking when you trade. One, we show you probability calculator. It determines the risk by showing you the short-term support and resistance levels. It also shows you what is the probability of stock reaching a certain price point by the expiration date. So probability calculator is very important for stock traders and option traders because it gives you statistical analysis of what is the probability of stock being at a certain price point. One standard deviation that you can see on the probability calculator is the basic statistics. You will hear a lot when you talk about option trading that you are looking for 30% gain between the strike prices of a spread, or whatever the strategy you're executing, you usually want 30% gain between the strike prices. That means you're looking for roughly 68% chance of being correct. So basic statistics is very important. That means you need to know what are the odds of your trade being successful. What other tools we're using? One is the historical volatility. It shows you how the stock behaved in the past and how volatile the stock is. Implied volatility shows you what is the future performance of underlying stock and how can you use this information to predict where the stock is going to be in the future. And again, the most important concept that we advocate at TradeSpoon that you can see on every trade recommendation that we make is the higher return on capital means the higher risk. If you look at our probability calculator, you can structure your trades where you can be 80% of the time. You can be 90% of the time by selling out of the money options. But that comes in price. That means you're taking higher return on capital. So if the trade does go against you, you have to be very aggressive in defending your position. And just like anything else in life, there is no magic. You also see on the screen the chart where we show you historical volatility and implied volatility. And to be a successful trader, you have to study the movements of implied volatility. If you trade Twitter, you trade stock, you trade Google, or Microsoft, you gotta learn how implied volatility changes between the earnings seasons, between different binary events, so you become more comfortable, more confident trader. So some of the definition of historical volatility just shows you a measure of volatility of underlying stock or future contract. Historical volatility can be thought of as speed rate of change of underlying stock price. How often does the stock price change? And that's what historical volatility is. The higher volatility, the more movement, the more risk you're going to see in the underlying asset. Implied volatility is a function of an option price and is baked into price of an option. You know that you can use different models such as binomial model or binomial equation to predict based on option prices what implied volatility can be. You also look at the dividends and different other attributes such as interest rate. Implied volatility shows the expectations of future volatility. As you approach in earnings, implied volatility will expand. Think about implied volatility as an uncertainty in underlying asset. So if implied volatility is elevated, such as before Apple earnings, implied volatility will be elevated. And this is the future expectation of what will happen to the underlying asset. So look at the probability calculator that you can find if you go to tradespoon.com. We show you probability calculator. Our models predict stock prices based on option expiration cycle, which is very important for option traders. So what you can see on your screen, first you see support and resistance. Our prediction for the next 50 days, what is the support and resistance? If you're a weekly trader, what is the support and resistance for the next 5 days, for the next 10 days? We also show you our trend prediction. You can see our trend number and the buy sell rating that shows you, based on our models, what is the probability of the stock being higher or lower, and how predictable the stock behavior based on our neural network analysis. The next, you see implied volatility for 50 days. Based on implied volatility, you can see the red and green arrow. Green arrow shows you, so for this Dow chemical company, What is the probability of stock being higher than $54.54? Well, that's only 11.9%. That means roughly 11% of the time you will be correct if you buy 55 call. So if you buy 55 call and you only 10% of the time you're going to be right, that's probably not the best strategy if you're bullish on Dow. You might be better off paying more and buying 45 call, because you see that there's 71.64% probability that Dow Chemical will be between 47.16 and 54.54 in the next 50 days. Also on the bottom of your screen you see historical volatility, that shows you analysis for the past 50 days, how volatile was the stock. And then you can compare the implied volatility, the future, versus historical volatility, the past, and see if there is a discrepancy and what is happening in the underlying asset. And again, remember this key, one standard deviation. It's not a magical word, but if you go back to your math class, in terms of the statistics, you know that when certain event happens, you do it over and over again, like rolling a dice or rolling 2 dices, you know that 68% of the time you will get numbers like 6, 7, 8, and 5. So this is the same kind of concept. If you trade options over and over again, one standard deviation, meaning that 68% of the time stock will be between certain price points. So this is going back to the math class. One standard deviation for options that you can see on your screen can help you determine support and resistance of underlying stock based on implied volatility, future indication, or historical volatility, the past. One standard deviation, what does it mean? It's a 68% probability for stock reaching strike price levels, which you see on your screen, U, by a certain date. And U minus 1 is 1 standard deviation, U minus 2 is 2 standard deviation. And 2 standard deviation, as you see on your screen, meaning that 95% of the time stock will be between these key price points. And Bollinger Bands is another technical indicator that you can use to make that prediction. Please be sure to visit us at tradespoon.com for upcoming webinars, and also follow us on social media. We have a handle on Facebook and on Twitter, and we encourage you to follow us on social media. Thank you very much, and be sure to view other videos in our library that can give you more insight on how to become a more successful trader.